Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Clinton Orr. Thanks for being on the show, Clinton.
Thanks for having me, Whitney.
Yeah, I'm honored to have you on the show. It's a great topic for this industry that you better know something about this topic, or you better know somebody that's a specialist, I guess I should say, like Clinton, because it's such an important piece of this business that we're all in. And so, and I'm gonna let him explain. I'm gonna tell you a little more about Clinton. But first, I want to tell you, make sure you're going to the Facebook group, the Real Estate Syndication Show, and getting involved there and asking experts like Clinton and other people in their questions about what you have going on, and connecting with other people in your market and other markets as well. And so get in the group, go to Life Bridge Capital and connect with me. And so we can talk personally and help you any way I can. If you're enjoying the show, I hope you will share it, and I hope you will leave a rating and written review. I would be grateful for that as well, so other people can learn about the show and learn and grow their business as well. So a little about Clinton. He's a specialist in multifamily insurance and a commercial lines coverage specialist. Since 2011, he has insured all types of multifamily properties across the United States and has become an expert in Fannie Mae and Freddie Mac loans. His passion for real estate started at a young age, watching his parents successfully invest in real estate. At the age of 19, Clinton started his own real estate investment company while attending the University of Central Florida, and has invested in many types of properties. Since starting his career in insurance, his goal has always been to take the mundane and mysterious world of insurance and teach it to investors as a tool to maximize profitability and to assist in both the sale and acquisition of properties. So, Clinton, thank you again for your time. I appreciate you, being on the show today with us, because this is such an important, piece of our business. We got to have insurance. Right? I mean, because it's a must, right?
Yep,
and we're going to have it. But, and I find even more importantly, it's so important to have somebody like yourself that's a specialist, on our team, on our team. So, so we can go to you and say, Clinton, okay, this is the type of deal we're looking at. What's the insurance going to run? What are some things we need to be thinking about here that maybe we wouldn't think of? Maybe we're in a different market. We're going into a new market, that maybe there's, I don't know, it's exceedingly cold in this market, or hot, or, they're exposed to more hurricanes, or, all these things that you may not think of without a specialist on your team like yourself. And so, appreciate your time again. Tell us a little about, what you do, and let's dive in.
Great. I appreciate it, Whitney. I just want to start off by saying thank you for having me on. I listen to your show, your podcast on a regular basis, and it's good to be rubbing shoulders with some of the people I've got to listen to in the past. So thank you for those kind words. As far as kind of what we see and what we do, we try to dub ourselves the real estate investors, insurance specialist. We deal a lot with syndications, individuals, large groups, small groups, large portfolios, small portfolios. What we try to do on the front end with some of our syndications is help with your underwriting. There's been a huge shift probably in the last 18 months in the insurance market. So it's done what it's gotten hard, especially in the multifamily world. So what that means is prior to 18 months ago, insurance companies had what they called reinsurance companies. So it's basically an insurance company for an insurance company. And large institutional finance invested heavily into reinsurance companies because the returns were so good for them. And that happened year over year, pretty much 2011 to about 2017, 18. At that point, if you turned on the TV, you saw floods, snowstorms, earthquakes, California wildfires. Well, that has led to reinsurance companies paying out on insurance claims, which means that institutional finance was then getting lower returns on their money that they were investing into reinsurance companies. So they had decided at that point, well, we're going to pull our money out because there's better investment tools we can use. And that left insurance companies kind of sitting around, okay, well, how do we remain profitable? Well, what they've done is they have increased rates. They have made underwriting guidelines much tougher. And I'm sure a lot of you that have properties or that are looking at properties are experiencing these increase in insurance premiums. So what we try to do is team up with investors on the front end and say, okay, look, if you are going to underwrite something, you need us to look at this, or just an insurance professional to look at this, because at the end of the day, insurance is the most volatile line item on a pro forma. Your taxes are pretty much going to be your taxes. Your property management fees are going to be your property management fees. Your rents, obviously you can raise your rents, but your insurance, it can be. We had a situation probably about 4 or 5 months ago where the current owner had a fire claim and she was trying to sell her property. The fire claim, we were able to work with this particular carrier and get them to overlook the fire claim due to it had previous insurance, just without deep diving into that. Anyway, we were able to lower her insurance by about $30,000 a year, which increased the property value, the sale price, by $400,000. So little things like that, just being able to look at a line item and say, we should probably dive into this to get a more accurate number. On the flip side of that coin, if you're using a current owner's insurance number on your underwriting, but you have a Fannie or Freddie loan that requires a lot more insurance, you could have your loan proceeds cut. So it's a very, very volatile line item that needs to be addressed on the front end and as you go through the process.
Okay. So I appreciate you elaborating on that too. Just how, you saved that person $30,000. That's massive. I mean,
that was a home run. That was a home run. I like sharing that one because it was a home run. But even the littlest of line items, premium savings. If you're paying $50,000 a year and you're talking about saving, even 10%, that's $6,000 a year. That adds up year over year.
So I like too that you are also a real estate investor, or you have been, in the past as well. Are you still investing in real estate personally?
Small stuff. I've got a rental house in Orlando that's always been, that one's going to be close to my heart. That was the first house I bought when I started our company back when we were 19. We were just kids, and we started doing tax deed properties, and we got an attorney involved and basically had them. This was 2002 and 2003, so we got an attorney to draw up an eBay ad for us, and we were selling tax deeds on eBay on 5-day auctions, no reserves, and we made a killing, and we made a lot of money. But at 19, you could spend a lot of money. So my parents, who are real estate investors, they definitely talked me into, you better put some money into something safe. So that house was purchased with the funds of that. So I've always kept that one close. I lived in that house for a while. I like that rental house. We bought a few houses in Central Florida right before everything crashed. Again, it was a very, very good life lesson to go through that real estate crash and what we were doing and how we were doing it, because it taught me a lot. It taught a lot about myself and real estate for that matter. So at this point, I've got a few properties in Central Florida, some lots, some lakefront lots in South Alabama, but definitely are looking to do more. Would love to do more. Just waiting for the opportunity.
Okay. So, well, just what I wanted to mention though, is I like that, that you're not just in insurance, but you're also an investor as well. So, as you're looking at these deals, you have some experience. But, in your bio, or you mentioned on it as well, you're teaching investors and, as a tool in your bio said, maximize profitability, and to assist in both the sale and the acquisition. And, I'd just love for you to elaborate on that a little bit and what that looks like working with somebody like yourself.
Yeah, absolutely. So Typically, we'll have an investor come to us. They'll have an OM or an address or offering memorandum or an address of a property they're looking at. Sometimes they have in that offering memorandum, it's going to show, the line items. It's going to show, what they're paying in taxes and what their NOI is and, those types of things. So when we take a look at that, we will, they'll send that to us. We'll put together a quote based off of that information, some of the other information we pull from our databases online as far as building sizes, number of buildings, things of that nature. And we put together a quote. Now, this is where it gets fun, is if that quote is beating what they currently have, that as from an offer standpoint, you might be able to offer a little bit more because your NOI is going to be higher than what they currently have. So, or if you're selling, if what we do with sellers as well is we'll come in, even if they have a Fannie or Freddie loan, we'll offer them a quote maybe that doesn't have Fannie and Freddie requirements. So that offering memorandum might look a little bit better, for a broker to look at, so it all depends on what side of the fence you're on. If you're coming in as a buyer, you obviously want to try to, the first thing I always ask buyers, especially in today's environment, because their Fannie and Freddie loans are probably about 90% of what we're writing right now. So if you've got a Fannie or Freddie loan, you definitely want to make sure you're measuring twice, cutting once, right? So you want to make sure that, if we do a quote, it's going to be based off of your lender requirements. So you don't get a quote, put an offer in, using this lower insurance quote with the increased NOI, and then we have Fannie or Freddie say, we need to add this, we need to add ordinance and law, we need to add an umbrella, you need flood insurance, you need equipment breakdown, you need all of these pieces, and then your insurance goes up by 20%, and now the property doesn't look as appealing to you. So on the front end, that's what we try to do. With the seller, we try to get it down so it looks more profitable to, when it goes up for sale. So those are some of the things we do. Once the product is, or once the property is bought, we like to get with the owner. We have a loss prevention team, which basically comes out and just assesses the property from any type of risk, adverse situation. If there's cracks in the concrete, if there's, steps that need to be repaired. And I know a lot of people are like, that is, oh man, more CapEx, right? More stuff that we've got to fix. But long-term, big picture, we see that those things, if you have stairs that are decrepit, you will have a tenant that tries to slip and fall. And now you've got a lawsuit. It's the law of large numbers. That's just how it works. If there's cracks in the concrete, someone is going to slip and fall. You want those things fixed because guess what? If we do pay a claim, it's going downhill, meaning they're going to pass that on to you as the owner. They're going to say, hey, we paid out. Look at it from just like any other business. If you had a tenant that was constantly breaking things in your unit and it was costing you $800 a month to go in and repair all of the stuff this tenant was causing damage to, but they were only paying you $600 a month in rent, wouldn't you want to try to get rid of them as quick as possible and get someone in there that's going to make you a little bit more profitable?
Of course.
It's the same as insurance. If an insurance company has a risk that is costing them $100,000 a year in liability claims or water damage claims or, fires or things of that nature, but they're only bringing in $20,000 a year, well, at some point in time, from a profitability standpoint, they have to say, let's try this again in a few years when you make your property safer.
So are there any kind of checklists we could be using while we're going through this process or for insurance and for that piece of this puzzle?
Yeah. I actually, I have one right here that we try to go through, from a pre-LOI standpoint, as far as your underwriting and getting numbers to once you get into due diligence and doing a little bit of homework as far as the property, requesting loss runs from the previous owner, looking at their policy versus your policy and what your lender is going to want. A lot of properties, the location of the property is going to change your price. If you're on the coast, you can anticipate much higher insurance premiums. If it's a property built in the 60s, 70s, 80s, even early 80s, and they have aluminum wiring, That's going to be something that's going to increase your insurance costs. Things like that, looking into those. Is it student housing? Is it vacant? Are you looking at this property and saying, okay, this is a huge value add play. We're 30% occupied. So there's 8 buildings that are empty. Well, your insurance professional should know that, because that's going to be a completely different type of policy that they're going to have to write for you to protect you properly. So, once the property has been purchased, there's, this is what we do with all of our owners. We sit down and say, okay, this is your property now. This is what we found through our risk assessment situation. These are some things we want to see addressed. We'll circle this wagon in 90 days. And the objective is to make sure that, no one wants losses, not you as the owner, not the insurance company, not me. It affects all of us. I know that, that as from an insurance standpoint, there's a negative connotation, but it affects everybody when there's losses paid. So I think we're all on the same page as the objective is to make sure that this property is safe and profitable.
No doubt about it. And I wondered, I appreciate you going through some of those items, but I wanted to ask you, how often and how much is the difference from, say, the seller's insurance policy to what you're quoting, the new buyer? What's the normal, the difference there, say, even in the types of insurance or coverages that they have, to even the cost?
And I hate to do this too. It's going to vary. Because you could have, it all depends. Insurance is peace of mind, right? That's what I sell. I sell peace of mind. What might make seller give him peace of mind might not do that for you as buyer. We look at that line item. It is a starting point to say, okay, you're paying about this. And being that we've been doing this for 10 years, just about every day, we know if it's within ballpark, if it's reasonable, if it's a number that we look at it and you're at $150 a door, well, we're going to look at it and say, well, you probably don't have enough insurance. You're not covered properly. If they go in, and we have another one we're working on right now that they're close to $1,000 a door. We're like, okay, something's not right there. That's high. As far as per door, there really is. It all depends on coverage. If someone's got a Fannie or Freddie loan, or we're able to look at that number and say, okay, they might have flood insurance. That's why it's high, or they could have a Fannie or Freddie loan, and that's what's running it up. But there's just so many different variables, Whitney. It really is tough to just say,
sure,
this is a rule of thumb is you're going to be paying 10% more than the previous guy.
Yeah, I just wanted to reiterate, drive home that we need to contact somebody like yourself, maybe not just go off those old or the seller's policy. It's like, we got to have a professional like yourself on our team, so we can be, during the underwriting process, I want to know, I want a pretty good number of what that insurance is going to be, and be communicating with somebody like yourself. So we know that, long before, it's a final number, that we think the property is worth, or what the insurance is actually going to cost us, say, per unit or overall. So what are some of the bigger problems that you see, investors making on the insurance side, when we're, whether it's from underwriting or whether it's not getting the correct coverage?
Well, what I see a lot of, and especially now, is, these are investment properties, right? So most people are going to be number driven. They're going to look at a quote and say, well, this one's $100 cheaper or $1,000 cheaper, whatever that number is. And you run the risk of, what are you going to do in the event in the event of a claim that's going to, increase your rates by 10 times that because you didn't have coverage, or you're going to have to come out of pocket. A lot of people get caught up on the number itself, and I get it, because look, that's what you're looking at. You're looking at a spreadsheet of numbers, and you want that NOI to be as high as possible, because for your investors and for you, and, but you also want to make sure that you're protected, because the last thing you want to do is go to your investors and say, hey, look, I know I saved us a bunch of money on our insurance, but that policy did not have ordinance and law coverage, and ordinance and law coverage is a big piece when you've got a building that you're looking at a value add play that the building was built in the 80s and you have a partial loss now, and the city's like, well, you've got to get this entire building up to code. Well, you don't have that. An insurance policy doesn't have that built in most of the time. That's an added coverage. Fannie and Freddie require it. That's how important it is. And if that's not in your policy, you're going to be on the hook, and you're going to have to go to your investors and say, hey, hey, I know I saved $1,000 on our insurance, but I need $20,000 to fix this claim. That's a tough conversation to have with somebody. So, I think that some of the other things I see as far as underwriting is some of the I guess schools of thought are use X for door, and we're just not in that market anymore. It's every market's different. Every construction type. Close proximity to coast. Is it vacant? Is it student housing? What type of roof? What type of wiring? There's so many different pieces and nuances that go to that. It makes it tough to say it's $250 a door, and that's what people are so used to doing because they want to, blowing and going on these underwritings. They're taught to underwrite 100 deals a week or 20 deals a week, and so plugging that number in is the fast way to do that. And I get that, and I understand that. I do. But if you go into a deal and you sign an LOI doing that, you're going to be disappointed. I mean, we've seen a lot of situations where lenders are cutting loan proceeds because of that, because, even lenders are doing it. We had a lender do it with a coastal property once. They used inland, offshore, like inland rates for a coastal property, and the insurance was about 30 or 40% higher, and they wanted to cut loan proceeds a week before closing up to $200,000. We had to get creative with deductible structure and things of that nature to kind of help offset that, and we got lucky doing that. But we see that very, very often where it's like you said, just no one knows what's going on in this insurance world. And that's what we try to do. We just try to, hey, look, this is what we're here for. This is, just like every team should have an attorney and a property man, and all of those things. We want to be the insurance guy for your team.
How does the finance piece affect the insurance?
So in what ways?
What type of loan we get?
So Fannie and Freddie, those are the real big ones. They're going to increase your insurance cost. But it's been my experience that even with the increased insurance cost, the juice is still worth the squeeze. The Fannie and Freddie, I guess, interest rates and things of that nature are still very, very investor friendly, even with the higher insurance rates, because we have investors that have Fannie loans and conventional loans and local bank loans, and they'll still go to Fannie if they can because the rates are so good. And at the end of the day, when we write a Fannie and Freddie insurance policy, when they have a loan and we write that insurance policy, I always feel much better about that policy because it does provide peace of mind. If it was my property and I was insuring it, that's how I'd want it insured. Especially if I had a team of people that are trusting me with their money and their investment, that's how you want it insured. They do it right. Now, if you could be a riverboat gambler and, increase deductibles to $25,000 and, lower cost to just what your bank loan is. And, you could do that and you can lower your rates. And if that provides you peace of mind and you're okay with, coming out of pocket in certain circumstances, then hey, that's your prerogative. But, typically with who your audience is and who you're talking to, they've got a lot of people they got to answer to. So I think that the Fannie and Freddie loans, they're going to increase your rates, but they're also going to give you that peace of mind to know that if a snowstorm or a fire or a tornado comes through town, you're covered, you're taken care of.
So just a few questions before we have to go, Clinton, or before we're out of time. But what's a way that you have recently improved your business that we could apply to ours?
So we just got back from a conference out in Denver, which was great. And something that we definitely need to do. So we have kind of gone on a lot of webinars and trying to do the podcast to get I guess the news out there as far as insurance is concerned with real estate syndication. With doing that, we've been very fortunate to meet a lot of people. The problem with that is trying to, I guess, maintain that data and stay in front of those people. And so some of the things that we've learned is, as far as funneling some of this stuff from this past conference was real good stuff as far as how to do that and staying in front of these people and providing as much value as we can. I mean, that's at the end of the day, I just want to be, the mayor of my village. I want to be, when an investor thinks apartment insurance, I want my name to be the next best thing. So we try to be teachers more than anything else. So if there is, I'm sorry.
Go ahead.
No. So if there's ever a question, and I'll tell you, if I can't write this, here's a guy that can. To me, that goes a lot further with people than, closing the deal.
What's the number one thing that's contributed to your success?
I think that just being upfront and honest with people. And if I can't write your insurance, I'll tell you. If it's a good rate, I'll tell you. If the company's a good company and that's a good quote, I'll tell you. At the end of the day, I just want to be a part of your team, and that's it. I want to be, like you said, the insurance professional. If there's an opportunity to do that, great. If not, well, I'm a fairly young guy. I've got a long time in this business before it's all said and done. So, that's pretty much, I guess, my spiel.
Yeah. And how do you like to give back?
Information. I mean, basically what we've talked about today, like you said, what we've experienced is not a lot of people know about insurance and doing this. They've got their full-time job that they're trying to transition to become a full-time investor. And let's face it, insurance is boring. It really is. It's not a cool, I have yet to meet a child, and I've got 3 children myself, that grow up and say, you know what, I want to be an insurance salesman, so that doesn't happen. So we try to make it, simple and easy and teach them what they need to know to kind of make our jobs easier. And
most importantly, how can people get in touch with you, Clinton?
Okay. Yeah. My direct line is area code 256-975-4964. My email is orrc2@nationwide.com, or you can find us online at theinsuranceguyonline.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.